Hello and welcome back to smarthelping.com. We got a 3D printing financial model. It's been a couple months since I actually did a full financial model, so I was really excited to get this done, and I'm actually really excited about the space. It's definitely a growing field here in 2020, and there's actually a couple different types of business models you can go with here. The first one, which is what I'm going to show in this template, is basically a company who buys 3D printers and makes stuff with them and then sells those things that they make. The other model would be kind of a 3D printer manufacturer where they build 3D printers and sell them to people like this business. And so the logic is very different for each one. So we'll focus on the one where we're gonna build products with the 3D printers and sell those. So you're gonna have research and development, software engineers, all kinds of things. You're gonna try to get a niche, but there's just all kinds of opportunities in this growing industry. So I figured let's do a financial model around it. So I'll just go through each tab, explain what's going on, and you'll see how the logic flows, and you can see how you can strategize with this model all the way from investors to cash flow distributions. Um, and you'll see as we get into all the assumptions, there's a lot of cool logic in here. I'm really excited actually to get through this. So let's start on the control tab. First, we have our main project level assumptions like the start year, the exit month if applicable. If you choose a month, it'll stop everything at that month, and it will assume you have an exit value based on a multiple of revenue. Now, if you don't want that to show up anywhere, you can just go to NA, and that's fine, and it'll flow through. Um, you can see the model here will just go all the way to the last month if you just have NA, and there will be no um, exit value defined. As you can see here, if I put it, let's say for November, you can see all cash flows start or stop after November, and then you've got an exit value here based on this multiple entered right here. So we'll just put this back to the final month. Next set is cash sources. So you might have debt from a bank or a standard loan where you pay back principal and interest over time on some amortization schedule. You can define the amount here, and then on the actual debt schedule, make this red. You can define the term, the rate, interest rate, and all of these variables. Next up is remaining equity required. So this is actually going to look at all of the cash flows immediately, like startup costs, one-time costs, and your burn in the first however many months as you buy machines and start to bring on staff and everything else. You're going to have some burn probably. So the required equity is going to look at your lowest minimum position after accounting for how much debt proceeds you had, and that's going to define that as your equity needed. Now that equity could come from two sources mainly. It's either going to come from the owners or investors or a combination. And so you can see on our control, you can type in how much remaining equity, which is going to be here. Now, let's say you raised $2 million from a bank, then you're not going to need any equity. You won't need any investor proceeds, and you could just, the share for investors is going to be zero. Owners will keep 100%. But, and as you can see here on the distribution schedule, owners get everything in this case. That's not super well. It just depends. Everyone's scenario is different. But let's just say we're gonna only have 250,000 from a bank. Uh, we're gonna have to raise, let's say, 900,000 from investors, and then we still need another 600,000 after that, and that'll be the owners. Uh, and we'll give the investors, let's say, 40% of profits. Applied valuation is here. The remaining profit share goes to the owners, and then you can see your total debt and equity breakdown. Then the final one for this depreciation schedule, because you know this model goes all the way down to EBITDA and then EBT, which is earnings before taxes. So in order to calculate the earnings before taxes, you need to know depreciation. And since the 3D printing machines are gonna, a big expense, and tax deduction is going to be the depreciation. So I've modeled dynamically all of the depreciation that could happen each month based on how many machines are bought, when they're bought, and the cost of them. And then based on the useful life, it just is a straight line depreciation over time and populates that so we can calculate our earnings before tax figure. All right, well, that's everything to control. The purchases is the first big tab. So here's the bulk of your assumptions. This is probably where you spend most of your time planning. So the way I did, I was trying to think of what's the best way to scale out this kind of business in a model. So I've basically put in, we've got three main types of printers. They're all going to be their own cohort. So these three are this, and I'll separate these. These are all going to be shown on different line items, so don't like mix this section and this section and this section and this section together, because then you're going to not see, all the numbers will still be right on all the calculations, but it won't, like, it's going to calculate this top tier as a given section of revenues, this tier and this tier all separately, and then add them together. But if you want to see, like, on a monthly, you can see how they're separated here already. So just be aware of that. Now, the reason I did this is because you might buy different types of 3D printers, which produce different things that cost or that can sell for different amounts of prices to customers. So I put in, I mean, this is probably overkill here, but I want it to be as dynamic as possible. And you can also define here, so you define the type of 3D printer you're going to buy here. And this assumes you're going to go and buy the 3D printers. If you're manufacturing them, that's fine, but the logic is only going to allow you to put in what's the cost per unit for however many you make. And then that cost is just going to come in whatever month the purchase month is defined. So this is more of a model where you're buying machines from somebody else rather than making them and then using them, which I feel is a more common use case. But you could probably fit it into the other use cases, just it'll be general average numbers. So find the type, find how many you want to buy, and then the amount you're going to buy is obviously going to is going to drive your total purchases for each month. It's also going to drive how many sales you get because your sales, you're going to define here of however many starting sales per month you think you can get per each unit that you own. So you can say a given unit of this can produce X amount of sales per month. And the idea is that they're hitting their max capacity, or they're making as many as um, you need from, or they're, let's think about this. They're making they're hitting their max capacity, and you're saying you gotta, like, if each one can do, um, if there's demand, this is just, I put in random numbers here. Let's say the demand is 250 sales per month. This is going to do 250 sales times the amount of 3D printers that you have. And then you can define the max capacity here, which is 2. So obviously you're not going to have, you're not going to be able to produce more in a month or sell more in a month than you can produce in a month. That's kind of how we're doing the logic. So this will grow. So the idea is that you're going to have more sales in the future than when you first start out. So there's a monthly growth rate here on the sales count, which you can see on our sales matrix. It starts, and then it'll start growing by whatever percentage per month. And then when it hits, now this won't hit 2 because the growth rate doesn't result in it, but let's say the growth rate was 25% here. We would grow to 2 sales per month per 3D printer, and then cap out, and that's the max. And the reason why is because I've done growth rates, so we can't just grow sales can't grow forever for one machine or 10 machines. It has to, um, there's some limit there. It just can't grow to infinity. So you can define the max capacity, max sales per month in this column, and that will drive everything. So purchases, and the reason also why I wanted to do different types here is because you really might want to be scaling different types out at different times. So revenues won't start until the month after the purchase, in all cases. Um, but you can really strategize here how you want to scale out the purchase of different types of 3D printers and how much you want to buy over time. Next is direct cost. So that's just showing you, like, if you know each printer, you're going to have to buy, X amount of supplies per month to run it. If you wanted to like tie electricity to each 3D printer, how much it uses per month, just any direct cost that you want to relate to the monthly use of the 3D printers, you can put in here and then it'll total up here. And then that comes in, it's going to come in direct costs down here, right here. And you can see the logic is just simply taking the max amount of printers bought. So for this printer, we only buy 10 in the first month. So it's going to multiply whatever that variable cost is by 10. And then in the same vein, let's talk about how those sales work, because it's kind of confusing, I think, before when I explained it. So the revenue is going to do, um, it's multiplying the sales matrix by the cell H6 and C6 in purchases, which is H in C6, which should be the price and the count. Yep. So our sales matrix is showing per type of small 3D printer how many sales they can do each month. And then based on that, multiplies it by the count of printers that exist and the price. So, and this logic, I feel like there's a million different ways you can do it, but this kind of gives the most granularity, the most flexibility and strategization or strategy abilities to plan out how you're going to um, grow your business. So let's see, what do we want to go to next? We have fixed costs. That's going to show you just general, like, executive team stuff. Like, let's say you might have marketing spend, sales staff. Oh, wait, we started with sales and marketing. So these are all your selling costs, advertising. Then you've got your general cost, which is going to be most of your executive team, office rent, managers, web hosting, just anything that's general administrative would fit into here. You could pick the month um, that cost starts, and then what the monthly amount is over time. So it could grow each year. Uh, then we did R&D section, and then function of total monthly revenue. So this is basically only going to apply to credit card sales, and you just put in a percentage of revenues that you think would apply to that. You might have other costs directly related to revenues as a percentage. If you want to, if for whatever your situation is, you can apply that here, and then that's going to flow right into this section here. So it's not really a cost of goods sold, it's more of a cost of revenue section. Uh, and then gross profits after that, all of these operating expenses that you just defined in the fixed costs. Um, tab, and then we have startup costs. So this is going to be all your one-time costs that you spend right off the bat. Like if you want to build a website before you launch, you got some consultant fees, whatever there might be, you can put that in here. You've also got future one-time expenses that are not going to be accounted for anywhere else, that you put on here. You don't want to put the purchase of um, 3D printers in here because that's all happening already on this section. Now, I guess if you wanted to try to say you're going to build them all out before like the operations technically start, um, you could put it here, and then the purchases you could just put, well, no, because your depreciation is not going to work. So you have to use this for your purchases, and you don't have like you can start buying things in the early months of, let's say you're going to start buying these in January, February, March of 2020. Well, you can do that, but if you don't plan on starting to hire people till later, you can define that here. And so the first year is kind of the first couple of years you can have a lot of variability in how you actually start um, the cost of buying these things and then start trying to sell them or sell whatever they can make. Um, Next up, well, let's first go to the monthly P&L detail. So this is just breaking all of the assumptions we went over into a monthly form for 5 years. You can lower, expand, and collapse this if you just want to see high-level items up here in the top left. But the main thing is this is showing how you get to your main financial forecast numbers here. So you've got, all your revenues, operating expenses, you've got EBITDA, then you've got the actual purchases. So that's going to be important for the cash flow calculation, depreciation, which is a non-cash item. Then we've got debt service here, um, principal and interest, which is all, this happens variable based on what you're going to enter in here. Um, you got debt proceeds, debt balance, and then debt payoff, which again, like I said, if you have an exit month defined, it's going to pay off that debt is automatically in that month that you sell. You got the exit value. Then we've got earnings before tax. So this is not going to take into account the purchases of the printers because that's not um, tax deductible because they're fixed assets. So it's going to be depreciation expense. So you got the EBITDA, you've got depreciation, and then you've got interest. So those things deduct, and you've basically got your earnings before taxes here, and that's as far down as we go in the model. As far as we're not going to show taxes and then after-tax stuff on here. We're just going to show the distributions of this to investors and owners. Now, you could estimate taxes if you want to go into the fixed costs here and just put like income taxes and just estimate the amount, the monthly amount you're going to be paying in each year. You'd have to look at which years you're profitable and just do some quick calculations on the earnings before tax number. So it is possible to put it in here if you want to do that. And then if you did that, then this EBT would actually be EB. It'd just be your earnings on the monthly, which is completely fine if you want to do that. Then there's cash flow before equity. So this is saying all the operations happen, all of the purchases happen. You've got some money from the bank. So here's what the cash looks like after doing all of that stuff. And then this is going to define how much equity we need on top of everything that's happened. So we're just looking at the min cash position of operations. And after that, after purchases of your 3D printers, and the number comes in right here. So it's saying you need 1.5 million in equity to survive, and you can see that automatically whatever month ends up being, because that's basically going to the lowest cash position here. So whatever month that is, your cash position after equity will be 0. So it's basically saying you have just enough cash, assuming all of the assumptions that have been input, that you will survive and do this. Now you could put in your startup and capex like a reserve of say 500,000, and that would take into account. So that would be in theory at that point, if everything happens like you think it's going to happen, then when you're at 0 here, technically you'd have that 500,000 buffer that you put in here in the fix or in the startup and capex, because that's not um, being accounted for anywhere else. So that's just 500,000 you've taken off of that you're saying is cash needed, but you haven't actually used it. So again, another strategizing logic there. I'll zero that back out. So now we get to cash position after everything has happened. Um, Next is key metrics. So you can see I just did average monthly EBITDA per 3D printer, which is just taking your total EBITDA divided by the total 3D printers that are in existence. You got your break-even month, which is just doing break-even of the whenever you're paying back the equity with the cash flows, positive cash flows. Now this startup cost and capex down here actually flows up into cash flow before equity. So I just put those under because they're less important, but they still need to be somewhere. So that will flow up into here. The annual P&L tab does the exact same thing as a monthly, but it just aggregates everything on an annual basis. We already talked about the debt, depreciation schedule. Next is the executive summary. So this is just high level, like you've got revenue, gross profit, your main cost items, the percentage of revenues, total expenses, EBITDA, debt service coverage, your annual EBITDA per 3D printer, and then just your main other cash flow items, capex, debt service, purchases, startup costs, exit proceeds, loan proceeds, paying back the loan, equity, and then cash flow after all of that, and then the resulting cash position. Depreciation expense in our EBT down here, your break-even month and year, and then some financial summaries for the project, and then for the investor and owner, internal rate of return, the amount of equity required from each group, the total cash return to each group, the resulting equity multiple, and ROI. I then put together a bunch of visuals that I thought were kind of cool. You got your key revenues, expenses, EBITDA. Then I did revenues versus the main four expense categories. Then I just showed the main expense categories here. I did cash flow and position. So here you can see there's where we hit zero on the position, and then the cash flow is happening each month is driving that number. 3D printer count by type. I also did revenue per 3D printer, and I thought this was kind of a cool chart. So you can see the revenue of each type, kind of 3D, but in staggered bars. I thought that was interesting. Your monthly EBITDA per 3D printer on a line chart. The total revenue broken up by printer type. So this is the same as this, but it's just stacked bars on top of each other. So you can kind of see this is your total revenue at the top, and then your type 3 printers created this much revenue, 2 this much, 1 this much. Annual EBITDA for 3D printer, total 3D printer count. So the total. So this is basically the total of all of this chart here. Your total monthly revenue, and then your EBITDA percentage. And this is dropping. I put in random numbers here. So all the assumptions are arbitrary. You'd have to put in what makes sense for you. And just the way I have it set up right now, it's just the fixed costs are getting higher here, so margins are dropping a bit. But it will depend on whatever your assumptions are. All of these assumptions are completely meaningless. It's arbitrary. It's just to show that the logic works whenever you put in your own numbers. Finally, distributions tab. So this is going to show you the total cash returned, the total cash outlays. So this is basically all positive cash flow months, all negative cash flow months. And then you've got the equity that you're coming up with here. And then this is going to be less your debt, so the actual equity that you need in total, and then the actual net cash flow that's returned. after accounting for any negative months is here. And that's how we calculate the project's internal rate of return as well as the distributions to investors and owners based on the defined percentages on the control tab. You can see the internal rate of return for each. Then there's discounted cash flow valuation here. You could put in a discount rate. It shows you the um, net present value for both the investor and owner. And you don't have to have an investor here. You could easily zero that out and it'll just show for the owner. Or, well, like, you wouldn't just have investors at that point. It'd be just the owners. But there's lots of structures you could put together here. And you don't have to have debt either. That could be zero. It could all be funded by the owners. Um, Whatever the case may be, you can plan it out here. Okay, man, that was a lot. So again, I'm really pumped. This is going to be a model for $45. I think the value here is more, but the demand I feel for this type of industry is going to be higher, so hopefully it evens out. I think it'll be a very fair price. Next up, whenever I have time, I'm going to build a 3D printing model where you're manufacturing the 3D printers and then reselling them to people like this business. So who knows, maybe another month and I'll try and get that done. But this is great. You can buy this at smarthelping.com. I'm also going to put it up on Eloquent and eFinancial Models. All right, that's all I got for you. I'll see you on the next one.